Welcome to the Chad Slagle Show, coaching you to and through retirement, where planning meets purpose. Chad Slagle isn't just a financial professional, he's a coach dedicated to helping you take control of your financial future. With years of experience guiding families towards secure and fulfilling retirements, Chad is here to empower you with the tools, strategies, and confidence to make smart decisions with your hard-earned dollars. Coaching you to and through retirement isn't just his promise, it's his passion. This is the Chad Slagle Show. Now, let's hear from the coach.
Welcome to the Chad Slagle Show. I'm Amy Sharp, and joining me is the coach, Chad Slagle. He is the president and founder of Slagle Financial. When it comes to your retirement money, it's not just about how much you have, but where you put it. Today, we're talking about the three worlds of money and how to find the right place for your dollars. And Chad, it is great to have you back on the set. How are you today?
I'm wonderful. Always excited to be with you, Amy.
All right. That's what I love. We're going to learn something every time we sit down with Chad. Let's start at the very beginning. What are the three worlds of money?
So the three worlds of money are the Wall Street world, the insurance world, and the banking world. And in my opinion, you have to have a little bit of money in all three worlds in order to be successful in today's economic environment. But you also have to make sure you have an advisor that works in all three worlds as well.
Start from the very beginning with the first one, the Wall Street world. What does that look like?
So the Wall Street world would include stocks, mutual funds, ETFs, anything tied to the stock market would be the Wall Street world. Now, why do we put our money there? Well, number one, it offers growth potential, but it comes with volatility and no guarantees. But it's a great place to have some of your money for the long term. To keep up with the rate of inflation and the cost of living, but you are exposed to the ups and downs of the market.
What about the banking world? How does that fit in?
So the banking world, exactly what it sounds like. This world offers quick access and safety. In other words, that's where we have that 6 months worth of income. That's our liquid money. The problem is you're putting your money there to be able to get to whenever you want, but don't expect it to grow very much. So this would be your savings accounts, money market accounts, CDs, again, good for emergency funds and short-term needs. And this is where your cash lives. It's safe, but again, it's not growing much.
Okay, next one is the insurance world. How is that different, if it is at all different from the other two?
It is different than the other two, and it takes a little bit of both worlds and combines it into one. You know, the insurance world brings protection, guarantees, and tax advantages to the table. This is where you'll find tools like annuities and life insurance. Now, these tools can do a lot of different things for you. They're kind of your hybrid, if you will. They can offer income you can't outlive, protect your family, and even transfer wealth efficiently, all while avoiding unnecessary risk and, of course, that ups and downs of the market, that market exposure.
Okay, you know me, I always have to get a little history lesson from you. Where did this concept come from, these three worlds of money? Is this something you came up with?
I got to be honest with you, I probably didn't come up with it. We use it, and I guess as if it's our own. But I just think so many people out there today that we sit down with, you know, we talk in previous shows about that safe risk ratio and making sure you have balance. This is the three worlds that you have to have balance in. But so often we run into people that are retired or getting ready to retire in the next 3 to 5 years, and they have 100% of their money sitting in the Wall Street world. And that's probably not the best thing to have your money, because we talk about that Wall Street world, there's so many unknowns. You know, number one, we don't know if the market's going to go up or down. And you don't know how long you're going to live. So if you need income, having 100% of your money in the market probably doesn't make sense. But also we talk about the banking world, right? Should you have 100% of your money sitting there? Absolutely not, because it's not going to grow. It's not going to keep up with the rate of inflation or cost of living. That money is there for a certain reason. Then, of course, the insurance world, are you willing to put your money in there for a period of time to get that growth off of your money? So again, as I mentioned earlier, in my opinion, in order to be successful in today's economic environment, you have to have that proper safe risk ratio. You have to have that balance. And the way you do that is by having a little bit of money in all three worlds. And if you have an advisor that is telling you should have all your money in one world, you should probably run, not walk out the door.
That's what I was just getting ready to go into, was we really need these worlds to work together. Everything needs to, it's almost like planets rotating around each other. We need them to all be up there and doing their job. But like you said, if somebody says no to that,
yeah, if you have an advisor that only works in one world, it's not the advisor you need to be working with, because what they're doing is they're trying to fit a round peg in a square hole. And you could probably fit it in there, but you got to hit it really, really hard in order to get it in there. And you're probably going to break something. And the last thing you want to do is break your retirement by forcing it into certain investment vehicles that you probably shouldn't be in, that aren't going to be successful for you in retirement. So you have to be careful with that. And again, educate yourself. Why do you want to have money in all three worlds? What does that plan look like? But before you start building that plan and start putting your money into these vehicles and these worlds, you have to build a plan first. And the way you do that is by thinking 3-5 years out from retirement. What are my goals? What are my lifestyle goals? What do I want to do in retirement? What kind of income do I have to have coming in? And where is that income going to come from? So you really have to think it out before even sitting down with an advisor and putting the money into these three worlds and using these vehicles. Again, as you mentioned, they're rotating around each other. You have to make sure you're working, these vehicles are working cohesively together to accomplish your goals.
And this may all sound complicated, and we'll continue to have this conversation, but to go back to your point of we're just, the very beginning of that is talking about things, your goals, your dreams, your hopes, and that's a good thing. So why not start there?
And a lot of people think, I just want to get to retirement. Well, retirement is a journey. It's not a destination. Just because you get to retirement, you get another 30 to 40 years. So you have to think about, what does that 30 to 40 years for you look like, and really think hard about it. And that's why you don't want to wait till retirement to start thinking about it. You want to start thinking about it now before you retire. And if you are retired, you don't have a plan, it's not too late. It doesn't matter if you're 3 years from retirement, if you just retired, if you've been retired for 10 years, it's never too late to start planning and building that plan.
Okay, Chad, we're off to a great start. Thank you so much. Coming up next, we'll talk about why balance is critical, and we'll share a real life example of someone who got it right. Don't go away.
They say knowledge is power. Whatever you're doing, whatever your goals are, you'll probably never say you know too much. The same is true with retirement. The more you know, the more prepared you'll be for everything in store. And we've made it easy to get started. This free offer is packed with knowledge to help answer some of retirement's biggest questions. It's our gift to you. Don't miss out on this opportunity. Act now and claim your free offer today.
Retirement planning shouldn't feel like guesswork. I'm Chad Schlegel, and that's why we created the Schlegel Financial GPS, our step-by-step guided planning system. It's not a cookie-cutter approach, it's a customized roadmap built around your goals, designed to bring clarity to your investments, protect what matters most, and help you navigate tax and income with confidence. Take the first step, come meet our team, and discover how the Schlegel Financial GPS can guide you to and through retirement. Call today, your future starts now.
Your dream car, the open road, and freedom. It's just one turn away. Or so you thought. Even when things look good, hidden problems can ruin your plans. Think of your retirement. At first glance, your investments might seem solid, but under the hood, what kind of risk are you exposed to? And what about taxes, income, healthcare costs? Don't let your retirement dreams stall out. Act now and get your free risk analysis to help keep you in the retirement fast lane.
Welcome back to the Chad Schlegel Show. I'm Amy Sharp, and Chad, the coach, is here to help us make sense of the three worlds of money. And let's talk about balance, why it's so important to strike the right balance in retirement. We talk about this a lot on this show. It's essential to really a good journey. You talked about retirement being a journey.
Yeah, you definitely have to be balanced really in anything that we do, right? So as I mentioned earlier, I believe in order to be successful in retirement, you have to have a little bit of money in all three worlds, the Wall Street world, the insurance world, and the banking world. And you have to make sure you have an advisor that works in all three worlds. And if you don't, it could completely blow up your retirement. And that starts with the balance. So how much goes in each one? Well, it all depends on you, your goals, and what you want to accomplish in retirement.
Okay, when people don't have that balance, what kind of issues could they run into?
Well, when people don't have balance, here's what can go wrong. You put too much in the Wall Street world at risk. The market drop hits hard, especially in retirement when you're drawing income. You know, as I mentioned earlier, if you were lucky enough to retire when the market's at an all-time high and you had $1 million and you needed to draw 5% from that money, or $50,000 from that money, all you had to draw out was 5%. But if 3 or 4 months later, the market drops $200,000, now it's down to $800,000. To get that same $50,000 a year, now you have to go in and draw 6.25% to 6.5% of your money out. So you want to make sure it creates sequence of returns risk. Losing money early in retirement can completely devastate a portfolio. You know, and the other problem is we talked about earlier, a lot of people react when they don't have a good plan. They react with emotion, and people panic and sell low, which is locking in losses. So there's no guarantee of income when it's in that Wall Street world. So you can't just hope it lasts throughout the rest of your life. You really need to be a plan, because again, when you retire, you're retired. The other problem is if you have too much in the banking world, would be another example. Your money is safe, but it's not growing, often losing ground to inflation. That what it does, it creates a false sense of security. You think your money's safe, but over time you're losing money because of what we call tax and inflationary risk. And you're not building wealth or income if it's just sitting there still. So even though you feel secure, you're slowly going broke safely, because if you're drawing money out, you're probably not drawing enough. You're not making enough interest from what you're drawing out. And then, of course, we talk about the insurance world. Too much in the insurance world it could be locked up or inflexible, because again, when you deal with the insurance world, you have to be willing to put your money there for a period of time to get those returns or the safety that you want. So it can't become illiquid if overused, especially with the long surrender periods. Your money's locked up. It may not offer enough growth for long-term wealth building, and without proper planning, it can limit flexibility if life changes. So the right tools used the wrong way can become roadblocks instead of solutions. So you have to make sure you have the right tools in your toolbox to do the job.
One thing I love about when we get together on this show is that you always will bring a real life example to the table to really kind of drive home your points, because this can be a lot of overwhelming information that we share.
Right.
But when we put it to real life stories, and not sharing names, of course, real names, but this is the story of a balanced retiree, and we all want to hear it. So take it away.
Sometimes there's a lot of gibberish, a lot of things going around, and it goes over your head until you lay it down.
Gibberish, all good.
Well, it's good, but until you can lay it down in real life examples, clients that we work each and every day. So let's say we had a client, Barbara. She was in her early 60s, ready to retire after 30 years of hard work. She came to us worried because, like most clients that we run into today, our prospective clients, she had most of her savings in the Wall Street world, and she was scared with the downturn of the market. So it was in stocks and mutual funds. So she feared that market downturn could wipe out the nest egg that she's worked very hard for in retirement. At the same time, she didn't want to lock all of her money into annuities. Didn't want to put it there for a long period of time because she felt too restrictive. Plus, she wanted to make sure that if something happens to her, she actually wanted to leave a legacy not to her children, but to her grandchildren. So here's what we did for her. We created a safety bucket in the banking world. We helped Susan set aside 3 to 5 years of living expenses in cash and short-term accounts for emergencies and daily needs, that 6 months worth of income. This gave her peace of mind and liquidity without risk. Number 2 thing we did is we moved part of her money into the insurance world. So what we did is we structured some funds into a fixed index annuity. Fixed, you can't lose your principal. Indexed, it allows you to participate in the growth of the market if it goes up. But again, if it goes down, you can't lose it. And also it gave her some income guarantees and purchased a life insurance policy for those unknowns, that legacy plan. So this gave her a steady income floor. And most important of all, the big thing for her is making sure she set something aside for her grandkids. And number 3 thing we did, we kept the growth opportunities. In other words, we used that Wall Street world. So we kept a portion of invested in diversified equities tailored to her risk tolerance and, of course, her timeline. That's longer term money. If the market drops 20 to 30%, we have enough money set aside in the insurance world and the other world where it wouldn't affect her. So she wanted to have money there because why? That money was there for the long term. It's there to grow, keep up with the rate of inflation and cost of living. And that's money she would draw out down the road. So the outcome for her, the good thing, when the market took a downturn in her first retirement year, Barbara didn't panic because her guaranteed income and cash reserve covered all of her expenses. Number 2, her investment bucket had time to recover while she lived comfortably. And she passed away knowing her family was protected through the life insurance legacy. So she felt confident while she was here and in control, living her retirement on her terms. And I think the biggest thing for Barbara, what she did, she defined what was important to her. She wanted to make sure she had income, didn't want to lock it up, but also realized she couldn't have money just sitting in that CD not growing. So she realized she had to take some risk. But if something happens to her, she also wanted to make sure that she had money set aside for her grandchildren as well. And we were able to accomplish all of those things by using our financial GPS.
Yeah, she had this great confidence before she passed and knowing that her family would be taken away. And just quickly, I think, as people are watching this, if this is something they're looking for, what's the takeaway they need to take from this conversation?
Well, very smart lady. Again, educate yourself. Think about what does retirement look like for you if you're not retired yet? But also 30 to 40 years down the road, hopefully we all last that long in retirement. What does that look like for you? What's important to you? Who do you want to leave your legacy to? Because again, if you don't do it properly, you're going to leave it to the government or to a nursing home. So you owe it to you and your family to do that planning now.
Okay, Chad, thank you so much. When we come back, we'll talk about what can happen when the right balance isn't there and how an advisor can help you avoid common pitfalls. Stay right there.
More is usually better, but not when it comes to taxes in retirement. Tax rates might seem high right now, but these could be the lowest rates you ever see again. Think how that could impact your retirement. The good news is there are strategies you can take advantage of now to help lower your tax bill later and help get the most out of what you've saved for retirement. But don't delay. Time is limited and rates could rise soon. So act now to get your free tax analysis. Help uncover hidden savings and optimize your income in retirement. Take action and claim your free tax analysis now.
Hi, I'm Chad Slagle. At Slagle Financial, we know retirement isn't one size fits all, and it shouldn't feel like guesswork. That's why we created our Slagle Financial GPS, a step-by-step process that helps you build a custom blueprint for retirement. Whether you're focused on protecting your income, leaving a legacy, or simply gaining peace of mind, we'll walk with you every step of the way. Don't leave your future to chance. Schedule a visit with our team and let's get you successfully to and through retirement.
They say knowledge is power. Whatever you're doing, whatever your goals are, you'll probably never say you know too much. The same is true with retirement. The more you know, the more prepared you'll be for everything in store. And we've made it easy to get started. This free offer is packed with knowledge to help answer some of retirement's biggest questions. It's our gift to you. Don't miss out on this opportunity. Act now and claim your free offer today.
Welcome back to the Chad Slagle Show. I'm Amy Sharp here with the coach, Chad Slagle, and we're talking about the three worlds of money and why it's so important to find balance. You hear us say that word a lot here on the show. So, Chad, what happens when someone's retirement plan is out of balance?
Well, there's a couple different scenarios to look at. So let's say you have too much risk and too little safety. Market downturns can erode savings early in retirement, leading to stress. We're all stressed out and we lose money. Impulsive decisions and reliable income. Again, you're reacting with emotion, not logic. However, on the other hand, if you have too much safety and too little growth, low yield investments fail to keep up with inflation, reducing retirement income and increasing the risk of outliving your savings. And of course, too much locked in and insurance without flexibility, insurance heavy plans limit growth potential and your access to funds. If you need that money, you may not be able to get to all of it, potentially compromising legacy goals and missing opportunities. So these are a couple scenarios. That's why, again, we talk about the big one. You have to have that balance.
What are some of the common pitfalls that you see people fall into? It's always important to kind of give people kind of a list of what they need to be watching out for.
That's a good thing. We learn from our mistakes. You know, I tell my kids all the time, you learn from your failures, not your successes, right?
That's true.
So ignoring sequence of returns risk, retiring before a market downturn, can quickly drain savings, forcing sales at low values and reducing portfolios, unfortunately, maybe permanently. Keeping too much money in cash or low yield accounts, though, although feels safe, inflation erodes purchasing power, leading to more expensive retirements than expected. And relying solely on, say, the Wall Street world or Wall Street investments, high market exposure with no protection increases stress during volatility and risk depletion if markets perform poorly early on. In other words, you put that money and all of a sudden the market drops, that could be a huge problem. You're never going to get back to where you were. Or maybe overusing or misusing insurance products. Not used properly, locked funds in flexible products can limit growth and understanding their fit in a broader plan. There's a reason that tool is in the toolbox, but you don't use it for everything. And not having a plan for taxes and legacy, in other words, ignoring tax-efficient strategies or really not thinking about them can burden heirs and miss opportunities to maximize that legacy, what you leave to your kids and your grandkids. And the other one, here's the biggest one, don't go it alone. Complexity can overwhelm. Avoiding professional guidance may lead to missed opportunities and costly mistakes. Just like anything you do, you want to make sure you have a guide. You want to make sure that this is something, if you manage your own money, you do it 3 to 4 hours a day. Why not have a person that does it 6 to 7 hours a day, every single day, and they've seen, over 30 years, seen almost every scenario that's out there to be able to help you, that's actually kind of blaze that trail for you, if you will, so you don't got to go it alone.
Yeah, and I will always bring that up as we talk throughout every segment here, the value of having an advisor by your side. And like to your point, don't do the work. Go out and enjoy your time. I have parents that are in their 80s. I see them sometimes get kind of focused in on something, whether it be paperwork or going through something in the house. I'm like, no, go enjoy your friends and retirement.
Right. Don't worry about the money. You can't take it with you, right? As long as you have that plan and be structured properly. So I think that's the key. And the key, of course, is to have balance.
We started this segment using the word pitfalls. And so, yes, having that advisor is really going to help you avoid those little dips in retirement.
Absolutely. We talk about the pitfalls. We start. The thing you have to do is you have to start understanding your full picture, goals and concerns. And a lot of times when you do it yourself, you're not taking all that in consideration. You may be talking about this pile of money or this pile of money, or maybe just thinking about income. You have to make sure you're thinking about all of those things when it comes to building a plan. And then once you have everything together, then you can build a custom blueprint that balances safety, growth, and liquidity, what we call those three worlds of money, and making sure you have a little bit in all three. Now, how much goes in each one? It really depends. It's not cookie cutter. We're not all the same. We all have different goals. You have to think about your risk tolerance, your income needs, your lifestyle goals, your liabilities, your assets. We're all different. So it's not cookie cutter, but that is a good place to start us by building that blueprint. Now, how much goes in the roof, the walls, and the foundation? That depends on you. So what this allows you to do, this allows you to keep on track to make sure you're meeting those income needs, meeting those legacy goals. And really, I think about my wife and I and where we're at in life at this age, 10 years, 15 years before retirement. Once I do retire, I want to make sure that I have enough money set aside for me and my wife to last throughout the rest of our life. And when we do decide to walk out on life, I want to make sure that legacy that her and I have built over the past 30 to 40 years is set up properly to go to our children, our grandchildren, or our churches, definitely not to the government and definitely not to a nursing home. And the only way to do that is by building that plan.
And the only way to get that plan in place is to walk through the doors to meet your team. Just give us a scenario of what that looks like when someone comes through.
That's a good question. I guess the most uncomfortable thing, we're talking about uncomfortable things, is go to a workshop, watch the TV show. But most important of all, take that first step momentum, right? Take the first step through the door. When somebody walks through our door, it's really just about sitting down with them, not throwing any ideas or any products or investment vehicles at them. I really just, when a client comes in, my team and I really just want to sit down and listen. Just like you do with your doctor. Your doctor, you come in, and because he's a heart surgeon, he's not going to throw you on the table and start working on your heart, right? They're going to ask you what hurts, why does it hurt, where does it hurt, what are all the problems that you have, and then we'll come up with a solution for it. It's the same thing with investment planning and retirement planning.
Okay, very good. Thank you so much. Up next, it's the Coach's Corner. Chad will close out the show by telling you how to take control of your plan and make informed decisions about where your retirement dollars should live. We'll see you in just a few.
In life, it's good to know what you have to work with. Knowing how many nails you have before building that birdhouse. Knowing how much sugar you have before starting to bake the cake. But do you know how much income you'll be able to count on in retirement? Retirement savings are one thing, but knowing how those savings can turn into income is another. Are you confident you know what your retirement income will look like? Call our team and get a free income analysis today. We can show you what you might expect for income in retirement. Find out now so you won't have to wander later. Call for your free analysis today.
Retirement planning shouldn't feel like guesswork. I'm Chad Slagle, and that's why we created the Slagle Financial GPS, our step-by-step guided planning system. It's not a cookie-cutter approach, it's a customized roadmap built around your goals, designed to bring clarity to your investments, protect what matters most, and help you navigate tax and income with confidence. Take the first step, come meet our team, and discover how the Slagle Financial GPS can guide you to and through retirement. Call today. Your future starts now.
Your dream car, the open road, and freedom is just one turn away. Or so you thought. Even when things look good, hidden problems can ruin your plans. Think of your retirement. At first glance, your investments might seem solid, but under the hood, what kind of risk are you exposed to? And what about taxes, income, healthcare costs? Don't let your retirement dreams stall out. Act now and get your free risk analysis to help keep you in the retirement fast lane.
Welcome back to the Chad Slagle Show. This is the part of the show where we turn it over to the coach, Chad. There are a lot of decisions to make when it comes to your retirement money. Give us some final thoughts, Chad, on how people can take control and build a plan that works for them. Chad?
Thanks, Amy. When it comes to preparing for retirement, one of the most important things to aim for is balance. You want your money working for you in the smartest way possible, and the truth is that requires pulling from all three financial worlds. When you blend these three worlds the right way, you can achieve something pretty incredible. You get growth from the Wall Street world, guarantees from the insurance world, and liquidity and safety from the banking world. All three elements work together to protect your income, secure your lifestyle, and leave a legacy for your loved ones. It's about building a plan that's not just strong in one area, but complete and balanced across the board. But here's the thing. Not all advisors work in all three worlds. You've probably been to workshops where the advisor told you to put all of your retirement savings into an annuity. Why did they say that? Because they only work in one world, the insurance world. On the other hand, you've probably seen commercials on TV where the advisor is telling you he hates annuities and you should too. Why do they have that opinion? Because they work only in the Wall Street world and they want you to put all of your money in the market. The truth is, they're both wrong. Putting all of your money into just one of these worlds will either leave gaps in your plan or expose you to unnecessary risk. What you need is a strategy that draws the best features from all three worlds. That's how you create a diversified, resilient plan that works for you in all kinds of market conditions. That's why it's so important to work with an advisor and a firm that understands the benefits of balance. You want someone who isn't stuck in just one world, but who can guide you with a comprehensive approach tailored to your specific needs. When you have what I call a balanced blueprint, you're not just setting up a retirement plan, you're building peace of mind. With the right balance, you can have steady income, the freedom to enjoy retirement, and confidence knowing your plan is built in more than just guesswork or risk bets. You can focus on things that truly matter, like spending time with family, traveling, or pursuing your passions, without fear about where your money's coming from or whether it will last. If you're ready to create a balanced, dependable retirement plan that incorporates growth, guarantees, and liquidity, my team and I are here to help. That's where our financial GPS comes in. Imagine getting in your car to take a long trip. You wouldn't set off without a GPS, right? It tells you where you're starting from, where you're headed, and how to get there as efficiently as possible. Well, retirement works the same way. That's exactly why we developed the financial GPS. Our financial GPS does for your retirement what a GPS does for your drive. It helps you figure out where you are financially, what your retirement goals look like, and the best strategies to get there. It takes the guesswork out of planning and gives you a clear, step-by-step roadmap to follow. And here's the best part. My team and I are ready to put the financial GPS to work for you. We'll sit down with you, understand your unique goals, and guide you every step of the way. Don't leave your retirement to chance. Reach out today to get started with your very own financial GPS. And remember, folks, retirement is not the beginning of the end. It is a new beginning. That's all we have for this week. Back to you, Amy.
Thank you, Chad. Such great advice to end the show today. And thank you to our viewers for joining us. Remember, where your money lives is just as important as how much you have. Take control of your plan and make sure it works for you. And we'll see you next time right here on The Chad Slagle Show.